Welcome to the week of December 19th. I'm Will Woodall, joined as always by Mike Rarey. Hey, Mike, how you doing?
I'm good, Will. How are you?
You getting ready for the holidays here as we wind down?
You know it. Got the kids pumped full of antibiotics. We're not going to miss any more days of school. No Christmas, no nothing. We're ready.
That's awesome. I got a little holiday background here for this shoot. This will be our last shoot of the year. We're going to talk a little bit about what happened in 2022, why things happened the way they happened, and then touch on a little bit of what we think how 2023 will sort of unravel or reveal itself to us. Let's start with the dominant factor, which has been the dominant factor for many years, but was what was once again this year in particular, and that's the Fed and the path they've taken throughout 2022.
Yeah, and this has been the second fastest Fed funds rate hike cycle in history. So we're only 10 months in. And the only faster rate hike cycle we've ever experienced was in 1980. Paul Volcker finally broke inflation's back and ended the great inflation. Every other rate hike cycle of anything near this pace was during the great inflation, the 1970s into the very early 80s. And when everyone in the market is addicted to ultra loose monetary policy and ultra low interest rates, and then you go through an interest rate shock of this magnitude, crazy stuff happens, right? In pretty much every asset class. And it's just been such a wild ride. If you think about the amount of liquidity and money created post COVID 19 in 2020 and 2021, and now how quickly the Fed has taken that away, it's just been whipsawed for lack of a better term.
Yeah, and so that's the rate hike cycle, which is very impactful. But there's also been the beginnings of a balance sheet runoff. So maybe just explain what we've done so far and how that's added to this.
Yeah, not only are you seeing the interest rate hikes, but that's only one of the Fed's monetary policy tools. The other one is the Fed grew their balance sheet to $9 trillion and have only just started reducing the size of the balance sheet. So in reality, monetary policy was even looser than most people would have thought if you just looked at the federal funds rate during 2020 and 2021. And now it's even tighter than would be implied by simply looking at the change in the federal funds rate.
Right. And so the Fed's actions have resulted in some pretty historic returns for stocks and bonds in 2022. And if we can throw up the next chart and take a look at the outlier here of 2022 and where it sits.
Yeah, the vertical axis is US large cap stock returns. They're down about 18% year to date in 2022. And then the horizontal axis is the return on the 10-year US 10-year Treasury note, the total return there, which down about 15% year to date, the worst year ever for high quality long term government bonds. And so if you look at the combination of those things or the intersect, that's that 2022 dot, and it's just out there all by itself. I mean, this will be only the third year that US stocks and the 10-year Treasury note have had a negative return in the same year. And it will go down as one of the worst years for a diversified stock bond portfolio ever.
Yeah, and interestingly, if you look at the dots, obviously there's a lot of down years in equity, but very few down years in bonds. And maybe transition to what that means on the next two charts we'll look at. One for stocks, and when they have a down year like this, what typically happens in the year following.
Right. So looking at the 10 worst calendar years for US stocks, those are the dark blue bars filtered from worst to, I guess, 10th worst. So 1931 was the worst, Great Depression down 43%. And then we go all the way to 1941, only down 11.6%. And you can see where 2022 ranks. It's bad. It's not unprecedented, but it's bad in terms of US stock returns. But importantly, what happens the year after? If you just want to be a contrarian for contrarian's sake and you want to buy the dip, Well, typically when stocks go down this much in a year, that's not necessarily a great strategy. It's never simple. It's never easy, right? When it comes to investing in a basket of U.S. stocks. I mean, if you look, it's almost 50-50 whether the next year you have an up year or a down year. And if you were to average all of those following years, you get a return of under 5%, which is pretty weak by historical standards. Long-term average US stock returns are in the 8 to 10% range. So just because stocks are down 18% this year does not mean now is necessarily the time to buy.
Yeah, absolutely. I just actually was reading a fund manager survey this morning where they stated the overwhelming majority of the fund managers believe that stocks will be down double digits next year as well. So you never know, but certainly it's a coin toss as to what could happen. However, in the bond space, it's a little bit of a different story.
And looking at the 10 worst years for long-term US Treasuries, so US Treasury bonds in the 10 to 20, 30 year, 20 to 30 year time horizon. 2022 was the worst year ever. So long-term Treasuries down almost 25%. And, it's not even close. I mean, this is twice as bad as anything we've ever experienced. And you think about why that is. Everybody talks about how horrible it was to own bonds in the 70s. And yeah, it was tough to own bonds in the 70s because inflation was running at double digits. You weren't making any money after inflation. But the nice thing about owning bonds in the 70s was you were getting double digit yields. You were just clipping coupons. And so when you have a year like 2022, not only is it because yields rose, we know that, but also the yields were so low to start. You didn't have any coupon payments to offset those price losses, right? And so that's why this was an unprecedented year in terms of losses for long-term government bonds. Your yield at the start of the year was 1.5%.
Yeah.
So no cushion, right? So that's the first thing. And the second thing is, if you were to just be a contrarian for contrarian's sake and just go out and say, hey, this is the worst year ever for long-term government bonds, I'm going to start buying them. Well, that's actually decently supported by history. On average, after any one of these 10 worst years, long-term bonds gives you a return of over 13% throughout these years. And 7 out of 9 of them are positive. And you think, well, you just told me the opposite about US stocks. Why is that? Well, math is working in your favor when it comes to long-term bonds, right? You lent the US government money. So every year that you get closer to that bond maturing, the price of that bond is going to get closer to par. So you got that working for you. And then you experienced 25% losses this year because yields went up. So now you're compounding much more attractive yields. So those things automatically work in your favor. And that's why it's very difficult to see an extended, prolonged period of substantial negative returns in bonds. And we wouldn't say just go out and start buying long-term bonds with your eyes closed, but they are starting to look very attractive for a number of other reasons.
Well, yeah, I mean, just in the recent weeks, we've seen, an over 10% return in some of those long-term bonds. And as inflation has come down, we're seeing the impact of that on the fixed income market. So perhaps we're already starting to see that sort of turn and look more favorable. So going into next year, obviously, if you've followed our videos, we're very pro fixed income as we head into next year. So we'll be interested to see how it plays out. But the odds in this case historically are in favor of allocating more heavily to bonds. Let's go to the next chart and look at the range of portfolio returns. I think it's important for people to get some context as to the universe of returns that their portfolios have experienced. And these numbers we're looking at are through last market close, which would have been last Friday, the 16th. So Mike, take us through what we're looking at here.
Yeah, if you were to have just, put on a blindfold and randomly picked an asset allocation fund in Morningstar's universe, odds are you would have been down anywhere between 4.8 and 19% this year. and the median outcome would have been down 13.9%. So that's obviously awful. We talked about how this is arguably one of the worst years for a diversified stock bond portfolio in history, and that definitely proves out in the numbers. So, these charts, they're showing the 5th percentile at the top, the 95th percentile at the bottom, and then that median in the line in the middle. What's not shown in here is, some of these allocation funds really made some serious mistakes, and there were some allocation funds, relatively conservative allocations, that were down, close to 30, even 40%. So it was an extremely difficult year. It was very difficult to make money, right? But the point is, if you can reduce some of those losses, reduce some of those drawdowns, and stay in the game, what you can do is to continue to compound longer term returns, right? Because if you look out over the prior 3 years, prior 5 years, prior 10 years, basically what happened this year is we gave up about 1 year worth of returns, slightly more than that if you got caught off sides and you had significant negative compounding in this year. But we're coming off this stretch of incredible gains for diversified portfolios, and really taking the edge off this year is how you stay in the game and have successful long-term outcomes.
Yeah, I mean, look at the 3-year number, 14% per year over the last 3 years, which is a substantially strong return for any investor over that time period. It sort of translates well into our next graph, which is looking at the past 3 years of booms, bubbles, and busts, and looking at different asset classes, because there's been a lot that's happened that I think maybe this chart will help give context to sort of the ride we've been on since COVID.
Yeah, we do them in sort of a clockwise fashion. You can just see, how riding this wave of liquidity has just led to these extreme regime shifts within asset classes, and asset classes going from totally unloved to the belle of the ball in less than 12 months time period. So these are all growth of 100 since 1/1/2020. And if you start out with looking at bonds, well, in early 2020, if you were investing in very, on the brink of default high yield bonds, you were thinking you were going to lose about everything. Unprecedented economic drawdown. If you're invested in really low quality high yield bonds, you're pricing in almost guaranteed default. And on the opposite end of the spectrum, if you're owning long-term government bonds, the yield dropped all the way down to 1.25. You're in recession. You're thinking this is the greatest macro bet of all time. And then a year later, you can see how it totally unwinds. And now at the end of this time period, you actually have made money owning very, very low quality high yield bonds. You've lost money owning long-term government bonds. And if you had cash, you actually weren't that bad. It was the worst investment to own for a decade was cash, decade or more. And in the fixed income space, actually cash looks relatively attractive.
Yeah.
Made about $2.
Yeah.
And you see these different regime shifts in other asset classes as well. So if you go upper right, U.S. equities, green line is NASDAQ 100. We know coming out of COVID, everybody was going to stay locked up in their house forever looking at their screen. And so you only want to own tech companies, social media, and telehealth, et cetera, et cetera. Why would you ever want a high quality dividend paying stock or a small value stock? But just has totally round tripped. And now it basically is a wash, right? Over this entire time period, high dividend yielding equities are up just about as much as the NASDAQ, because the NASDAQ has caught down to high quality dividend paying stocks. And those dividend payers have just been compounding dividends, which has been great. And then, real assets, bottom left. Nobody wanted to own real assets for the entire decade prior to 2020. I can't tell you how many discussions we've had with clients. Why do I own commodities? They're the worst investment on the page, right? Negative returns out to 10 years. What are we doing in commodities? Well, this is why, right? This is how diversification works. A basket of commodities, the blue line, you would have made $43 over this time period cumulative. Your home is probably up about 40%, home prices. So if you were to take the Case-Shiller home price index, rebase it to 100, you're now at about 140. And even tips, even though fixed income has been totally unloved, tips, now with the rise of inflation, tips are hanging in there relatively well. You would have earned $5. So real assets have been the place to be. Nobody would have thought that during COVID, right? Or prior to COVID. And then, of course, you have the digital assets, where if you would have owned the Grayscale Bitcoin Trust or a collection of smaller cap digital assets, crypto tokens and coins, you would have made a lot of money. The reality is nobody owned these the whole time, right? Or very few did. Very few did. And a lot of folks that did own them the whole time probably haven't sold. So I don't know if anybody's really like made money here. But that definitely was the place to be. The most liquidity sensitive asset ever, right? And at one point you would have been up over 1,000% when we were at sort of peak money supply growth. And now, well, it's almost a wash between crypto small caps and commodities, if you can believe it. And then obviously at that, you only get that if you sort of dodged all of the sort of walked through the minefield here recently when it comes to investing in crypto, because something like Terra, for example, well, if you had $100, now you don't. You would have lost everything. So It has been a wild ride. It's been very exciting. It's what we live for.
So all of these examples are, and you mentioned liquidity driven. So all of this is liquidity driven. So the Fed pumps liquidity in, and all of these assets rise in value. And then the Fed takes the money out, and you can see, or starts to take the money out, and you see them fall. So how does this sort of play into the thought process going into 2023, as we're sitting here at the end of 22 with growth that's slowing fairly rapidly, a Fed that is very hawkish and is continuing to withdraw liquidity from the market, and a potential recession. Our indicators are suggesting recession's coming, or may have even been started. And then contrast that with the labor market still being pretty close to being the tightest labor market in history.
Yeah, big question. Since we're doing all these historical analogs today, I think it's probably useful to think about actually 1937, which was the worst year ever for a diversified stock bond portfolio. And if you think about what was happening in 1937, the monetary and fiscal stimulus to sort of get us to recover from the Great Depression was finally starting to take hold. It was finally starting to work in 1937. So you think about this analog, well, 2020, COVID lockdown, that was the sharpest contraction in economic activity since the Great Depression. And then we had the biggest monetary and fiscal stimulus ever to get us out of it, right? It's all finally starting to work in the mid 30s. And then the central bank and the government both felt like they had created too much liquidity, too many excess reserves in the system, and started to withdraw. And they continued to withdraw stimulus for at least a year until they felt like inflation fears were gone and all of the irrational exuberance or potential irrational exuberance was nowhere to be found. And that was a very difficult time period. And you can see sort of where we're at right now. The S&P is down almost 20%. We're clearly on the brink of recession. The one data point within our recession indicator that's saying everything's still A-okay is the labor market, which is a very lagging data point. And here's the Fed continuing to hike interest rates. That is not something that we would have seen in 2018, in 2008, right? This is definitely something that most folks in their lifetime have not seen before. So, going back to another part of your question, what starts to look good next year? Well, if you forecast out inflation, liquidity, economic growth, and recession during the entire year, it's actually difficult to say. But we can tell you what looks good right now. What looks good right now are high quality fixed income securities, value stocks, small value stocks. They all look very attractive given where we're at now. And then it would be nice to be able to say with perfect foresight exactly how, if a recession happens, how it would play out, how deep it would be, how shallow, whatever. The reality is nobody can really do that. And so we update our models daily and we reconfigure portfolios accordingly.
Yeah, it'll be heavily dependent on how the Fed reacts to the recession when it happens, and how it reacts to the labor market slowing when it happens. If this is just a quick pivot, we'll be back to more. But there is a substantial opportunity here for the Fed to fight inflation and draw down the excess liquidity they put into the system right now. So until they signal otherwise, it's not going to be a great year for equities until we see that sort of start to change. So we'll wrap up here for the year. On behalf of all of us at CapStrat, we are truly grateful that you've spent the time with us and watched our videos. And we always want to be available. So if you ever want to go over our outlook with us or discuss any of the items we look at, please feel free to let us know. And thank you for a great 2022, and we look forward to a very interesting and very hopefully profitable 2023. So on behalf of all of us, have a great holiday season, and we'll see you in 2023.